exercise 620 in your text, which Connect calls problem 6, gives us a chance to practice what we know about goodwill. And again, let's go through and make sure we know what we're talking about. Okay, Arizona Corporation is the company that bought Data Systems. So that's the first fact we need. The next fact we need is that they paid $320,000 cash and assumed all the liabilities, all the debt that Data Systems had. Data's books, this company's books, and I'll use blue for Data Systems. Data's books showed tangible assets, property, plant, equipment, furniture, fixtures, boats, planes, trains, automobiles, of $260,000. Remember, a company's assets cannot include their talented workforce. It can only include stuff that you can legally own. Even if the greatest assets of an entity are its people, you still cannot count those as assets. I mean, if you're the Eagles or you're the Flyers, your most valuable assets are the athletes you put out on the field of play. You can't count those, so remember that. It's stuff, not people. So they had assets of $40,000, or assets of $260,000, and liabilities of $40,000. Owner's equity of $220,000. Well, that adds up. You take the total liabilities and the total equity, it's $260,000, so that they're in balance. At the time, an appraiser assessed the fair market value of the tangible assets at $250,000. Now we have to go through and see how much we paid, how much was goodwill, how much was the assets. And then they want us to put it in one of their silly little tables. So we'll play their silly little game and put it in one of their little tables. So, let's go. Problem 6, 620 in your textbook. Problem 6 in the real world, in Connect. Okay. Well, looking over at the facts, we paid $320,000 in cash. So that's how much cash we paid. But we're also going to be paying these $40,000 in bills. So that gets added to what we paid, because we're going to pay the bills. So altogether, between what we paid and what we will pay, the total is $360,000. The assets were appraised at $250,000. Now, at first blush, you want to say, well, that was stupid. Why did you want to buy those assets for $360,000 if you could have bought them for $250,000? Well, because the assets are doing business as Data Systems, and the value of the assets, because they're doing business as Data Systems, is worth more than just the assets by themselves. You know, I like to think of it as the value of all the parts of an airplane are not equal to the value of an airplane if you're at 30,000 feet in the air. The value of all those assets flying in close formation is worth a lot more than just the value of the parts. So, our total paid, and combined with what we will pay, is $360. The assets were appraised at $110. So they told us at the beginning, and all of their examples are really kind of weird. Every company so far has only had one asset, and it was cash. But we'll play along. Then they bought the company, they bought Data Systems, the acquisition, for $320,000. Here's the important part. The assets get listed at $250, and the balance is goodwill. That's the important part. Okay? And we have to remember that we're also going to be paying the $40,000 in the total liabilities. It's not necessarily what we paid now, but what we will pay. Nothing else changes. And when we made this purchase, this was indeed a cash flow, $320,000 out, and it was an investing activity. So that was just a little chance to give you an opportunity to play a little bit with goodwill. And the things that you have to remember is it's not just what you paid, but it's what you will pay when you agree to accept responsibility for the liabilities.